Well, good afternoon, everyone, and welcome to our Q2 Individual Equity Stock Portfolios Update webinar with Steve Galley, our Chief Investment Officer. We'd like to welcome you today and thank you for joining us this afternoon. We welcome your questions and we want the webinar to be as interactive as possible, and Steve has a lot of insight to provide, so please feel free to submit your questions to us through the Q&A or the chat feature, and we will get to as many as possible. So with that, I'd like to pass it over to Steve to go ahead and get started.
Thank you, Katie, and thank you all for joining us this afternoon. I hope you find this informative. We're going to try and keep it as brief as possible. I'm going to try and shorten these to 30 minutes. I know everyone's time is valuable. And we did get a couple of good questions in advance, so I'll try and address those as we go. So as usual, I will be going through what's going on out there in the financial markets because that informs what we're doing with the portfolios. In addition, we're also going to try and do what we call a hot topic on every one of these presentations, where we kind of dive into one particular thing that we think is important in terms of what clients need to know. Maybe clients are asking a lot of questions about a particular topic, or there's something going on in the market that we think presents an investment or a particular financial planning opportunity for clients. So we're going to be rotating these hot topics to hopefully really interesting subjects that will generate some interest out there. This time we're going to delve into bonds or fixed income, because we have been talking to clients a lot about bonds and bond strategy. So we'll dive into bonds today a little bit and answer a lot of the typical questions that we get. And then we'll open it up at the end also for some Q&A. So as you know, so far this year, there's been a lot of volatility in the market. The market is up so far this year, give or take, 7 or 8%, which is actually pretty good, only through mid-May. And that's despite the fact that we've seen a lot of what I would call negative headlines. Here's one from Barron's. This was last weekend about the banking collapses that we've seen and what that means. This one was a few days ago in the Wall Street Journal about investors being nervous, and that can be a contrarian indicator, because that usually is a good sign for stocks, because if people are nervous and not buying, it's kind of a contrarian indicator. It maybe means that it is time to buy. Here's a headline from Bloomberg. The debt limit default risk is higher than ever. And that gets into the politics of raising the debt limit ceiling of this country. We'll talk about that a bit. So when I say that, so far this year it's been a nice start, well, let's talk about why. I'm highlighting a column here. I'm going to try and use my highlighter if I can. You'll notice that the Nasdaq 100 so far year to date is up over 24%, and I ran these numbers as of yesterday. So that basically means that tech stocks have been the place to be so far this year, and that was, I think, a bit surprising. That was hard to know. I mean, obviously tech stocks were some of the worst places to be last year, so they have actually come back a bit. But you'll also notice the MSCI EAFE index, which stands for the Europe, Australia, Far East Index, which really is a good measure of what international stocks are doing. That's also up pretty well year to date, much more than the broad market. If we represent the broad market by the Russell 1000, that's up about 8.5%. So international stocks have been outperforming. And in particular, growth stocks have been outperforming at the expense of value stocks. So conservatism has actually not paid off so far this year, although we do think that might change a bit as the year goes forward. So I don't think it's time to rush into growth stocks. I think that might be a little too late. So this gives you a picture of what's happened, but basically year to date, there really isn't any investment sector that's done badly or poorly. Everything's in the positive. And almost every bond sector has done well also, whether it's munis or corporates or governments. So far this year, not bad, which I think is a nice relief to a lot of people who did experience, the negativity of last year. So far this year, it's clawed a lot of that back. Recession is still on everyone's mind. There's still a lot of talk about recession. But at the end of the day, we are not currently in a recession, right? And the only way we ever are officially in a recession is when the National Bureau of Economic Research says we are. And sometimes there's a lag effect until they actually declare that we're in a recession. Some people qualify a recession as having 2 consecutive quarters of negative GDP growth in this country. That's actually not the way we officially define a recession. And that actually already happened a few quarters ago. So, and we weren't in a recession then. So this is really a research piece from Goldman Sachs, where Goldman says, you know what, we actually don't think there's going to be a recession in the next 12 months, or more specifically, they only assign about a 1/3 probability that we will go into a recession in the next 12 months. The median forecast of whether we're going to go into a recession in the next 12 months, and this is all the other forecasters out there, of which there are well over 50 or 55 or so illustrious forecasters on the institutional side, about 2/3 of them do think we will go into a recession in the next 12 months. If that is the case, if we think that 2/3 of the forecasters are right, well, that does argue to be a bit more conservative, because stocks tend to underperform as we lead up to a recession. So let's talk about the stock market a bit in terms of, well, where were we a year ago in terms of where was the market value? So this chart, I think everyone knows how much I love this chart. It basically shows the last 25 years of market valuation as measured by the forward price earnings ratio. And what is the forward price earnings ratio? That essentially is taking the estimated earnings of all the companies in the S&P 500. So in other words, what do the analysts say the S&P 500 companies are going to earn in the next 12 months? And that you divide the price of the S&P by that aggregate earnings estimate to come out with the forward PE. So a year ago, and by the way, the 25-year average of over the last 5 years of the forward PE ratio was hovering right around 16 to 17. And a year ago, when we were looking at this is a number from May 11th of last year, we were right almost smack on the average, meaning stocks weren't expensive, but stocks weren't cheap either. They were trading right around their average forward PE multiple. So basically that meant for every dollar of earnings that I'm buying in the stock market, I have to pay 17 times that dollar to buy that dollar. That's basically what the market was valued at. Let's fast forward to right now, or I should say yesterday. Where are we at? Well, kind of close, right? We're actually not that different from where we were a year ago. Slightly elevated, right? We are now trading closer to an 18 forward PE ratio, which would argue that stocks are a slightly more expensive than they were a year ago, and obviously slightly more expensive than the long-term, or at least the 25-year average. Not dramatically expensive, but certainly not cheap. So again, when we think about that, and we think about, are stocks cheap or expensive? Obviously we know they're not cheap right now. We know they're slightly expensive. Again, probably not a time to be super aggressive in terms of the type of stocks that we're picking. So this is another chart that kind of shows critical turning points in the market and why we pay attention to those forward PE numbers. So for example, when the forward PE ratio of the market after the great financial crisis got basically as low as 10, well, that was a great time to buy, because then we saw, one of the nicest bull runs we've ever seen in the market, where the market proceeded to go up over the course of, the next decade by about 400%. Then, of course, the PE by that time was a little elevated by, 19, close to 20. And then we saw the big sell-off because of the pandemic. And then that brought the PE way back down to 13. And then it proceeded to rocket right back up until the beginning of 2022, where it was well above 21. Again, that probably flashed a danger signal. Stocks were expensive, and sure enough, they have come down. So the question is, where are we going to go from here? Are we going to gyrate around? Are we going to maybe revisit the lows that we saw earlier this year, or are we going to continue to move along and then perhaps revisit the highs? My uncle grew up in Brooklyn, and one of his favorite sayings was, "Nobody knows nothing about nothing." And to be honest, in terms of predicting the market, I think that's very appropriate. Nobody knows nothing about nothing. It's very difficult to know where it's going to go. But at the very least, we know that stocks are slightly expensive right now. Not super expensive, not certainly the way they were at the beginning of 2022 when we did see a big market sell-off. So how does that inform how we're looking at stocks? So we're going to highlight actually one stock that is part of most of our core portfolios. If you know who this gentleman is on the screen, Jamie Dimon, and you know who he is the CEO of JP Morgan, and JP Morgan is the biggest bank in the world. And JP Morgan happens to be a bank that we think is a smart investment to hold in portfolios. Why is that? Well, certainly JP Morgan seems to always be in the driver's seat to scoop up other banks when they get in trouble on the cheap. And that's exactly what they did with the First Republic deal. When First Republic was basically forced to get sold, JP Morgan was the lucky buyer. And I think they ended up buying First Republic at a very good price. Because what did they buy with First Republic? Well, they ended up buying First Republic's wealth management business, which, First Republic catered to, individuals who tended to be very well off, and JP Morgan coveted those types of customers. And so they paid mostly for that in that deal. And I think that's a good thing for JP Morgan's earnings going forward. And here we take a look at, this is what JP Morgan stock has actually done over the last year. And so when you look at the market, now when I say the market, I mean the S&P 500, that's represented by this green line. That actually shows what the S&P has done over the last year or so. And the blue line is actually JP Morgan. So you can see that JP Morgan has outpaced the S&P over the last 12 months. Whereas over the last 12 months, the stock market has only returned, or the S&P to be exact, has only returned about 2.5%, 3%. JP Morgan has been up over 12% over the last 12 months. So actually that has been a good holding in our portfolio. And if you can see on the next slide that JP Morgan actually pays a pretty nice dividend, right? The dividend yield on a go-forward basis is almost close to 3%. So even if JP Morgan stock really doesn't go anywhere for the next 12 months, well, at least we're earning, a fairly decent dividend from, some would argue, probably one of the safest, most well-capitalized banks in the world. The other thing I think is interesting to look at here is, and I'm kind of circling it here, is that the PE ratio of JP Morgan is only 10. Now, remember, we just said the market overall PE ratio right now is right around 18. So that means that JP Morgan is actually trading for a lot less than the overall market is trading, right? And so basically that means you can buy JP Morgan for a much lower valuation than most other stocks. And I think that's one of the other reasons we're pretty comfortable at owning JP Morgan, because we don't think we're overpaying for it. So I think, I wanted to point out that as one of the core holdings, but, of course, don't just take our word for it. We also consult a lot of research services that we think are pretty good at what they do. This is an actual value line report on JP Morgan. You can see the A+ financial strength rating. And out of 1 being the highest, it has a safety 2 and a timeliness 2. Now, I should note that what Value Line did recently is, because of a lot of the banking stress that we've seen in the system, they pretty much downgraded every single bank that they cover. No bank gets a safety 1 score from Value Line anymore. And that kind of actually dovetails a little bit into one of the questions we got in advance of this presentation, which is, how concerned should we be over the possibility of more bank failures, or in particular mid-sized bank failures? And also, do we have to worry about this debt ceiling argument, and is that going to be a problem? So there's a lot of different ways to answer that question. I would say yes, we do need to be concerned about mid-sized bank failures. And one of the things I'm happy to point out is that when we have financial services or the financial sector exposure in our portfolios, we actually really don't have much bank exposure, specific bank exposure, with the exception, of course, of a bank like JP Morgan, or we do own some other large banks, not the ones that I think might be in more jeopardy of getting some more trouble from what's happening with the First Republics or the Silicon Valleys or the signature banks out there. So we prefer, a lot of our financial sector exposure is in other areas of financial services like insurance, or in financial technology, or in financial data providers. We prefer exposure that way. So yes, we're concerned about that. We are avoiding, mid-sized banks in the portfolios. But I do think that the Fed and the FDIC have made it very clear that they are on top of this, and they won't let so what's really going on is we're seeing stress in the banking sector because interest rates have come up so fast. Whenever the Federal Reserve raises rates as fast as they have, they always break something. And in this case, they're starting to break a bit some banks that weren't prepared for that type of interest rate rise, that didn't properly manage their asset liability exposure. I think they're also causing some stress on the commercial real estate sector. So, could there be more bank failures? Yes. Do I think it's going to be a systemic problem? No. And certainly the market doesn't seem to think so. As a matter of fact, I think, the market might think this country in general is a bit overbanked. I mean, if you look at the way banking works in most other countries outside the US, there's really not that many. We actually have, more banks in this country than, the next 10 countries combined. So we definitely have, it's not, I don't think we're in danger of being underbanked anytime soon. So I do think there's going to be more consolidation. And I think that will overall benefit ultimately some of those banks that end up surviving and thriving. So that's a little commentary on what's happening in the banking sector. Again, we are avoiding more smaller and mid-sized banks in our portfolios, but we do think JP Morgan is still a pretty strong holding. And this is a Morningstar research report on JP Morgan. And I'll just highlight one of the things they said. The transaction appears to be a good deal for JP Morgan. I think that's slightly understated, but I obviously agree with that statement. So again, we're comfortable with that holding in the portfolios, and that's certainly one of our core financial holdings for individual stocks. So with that, I'm going to dive into the hot topic. One of my favorite topics, bonds. I actually used to be a bond trader at Salomon Brothers. Here is an image of a bond trading floor. And I have to tell you, it really looks exactly like this. Basically, all these rows of desks represent usually different areas of the bond market. There'll be your corporate bond trading desk, your government bond trading desk, your junk bond trading desk, as well as salespeople right across the way that will be screaming at the traders to buy this, buy that. So, and that's really what it looks like. And so one of the things that makes the bond market different is that there are many of these desks at many of the largest institutional banks out there, because the bonds trade over the counter. They don't trade on a centralized exchange for the most part, unlike stocks, where many stocks trade on the New York Stock Exchange, many stocks trade on the over-the-counter exchange or the NASDAQ. It doesn't really work that way with bonds. So to get into the details of bonds and why we think they're important for portfolios, well, bonds are less volatile than stocks, right? They're more predictable. Bonds are all about math, because bonds are about what am I getting paid over time from this bond. And you can do cash flow calculations to get a good indication of really what is the bond going to pay you, and therefore what is it worth today based upon what you're going to get paid over the life of the bond. So bonds really represent the debt of issuers, and issuers can be corporations like Microsoft, or it can be governments like the US government or a foreign government. And so it's really a type of loan. It's basically someone saying, hey, the US says we have a massive budget deficit. We need to finance that deficit. So here's a bond. Please buy it from us and give us the money so that, we will finance our deficit. And at the same time, we'll pay you an interest rate on that loan you gave us. And why are they considered more conservative than stocks? Well, on the screen here basically shows like a typical capital structure. And the point is, at the top of the capital structure, you're more safe. So at the bottom of the capital structure, you're less safe. And why is that? Well, so if you're a corporation and you have debt, and if you go out of business, well, the debt is paid first. So if you're a corporation and you have buildings that you can sell, or equipment you can sell, or intellectual property that you can sell, all that is sold off to pay off the people who hold your debt first. Anything that is left over in a bankruptcy situation like that, anything that's left over eventually gets filtered down to the bottom of this stack, which is why in some cases, if something goes bankrupt, if you own the common shares, common equity of that company, you get nothing because there's nothing left. So that is inherently why bonds are safer than stocks, because even if a company that you buy a bond from goes out of business, you have a claim to the assets of that business. So they are more conservative than stocks, and therefore, obviously, they're less volatile. And there's many different types, right? There's government or treasury bonds. There's corporate bonds. There's also muni bonds, and we're going to talk about muni bonds specifically on the next slide, but they tend to be, they're tax-free at the federal level and sometimes also at the state level. And there's also mortgage-backed securities or mortgage bonds, right? And what are they? Well, those are bonds that are basically built by packaging together hundreds of mortgage loans into a bond that then is cut up in terms of the risk of the mortgages. There's always also an ever-changing inventory of bonds. So even if, let's say, someone says, hey, Steve, I saw this bond by Caterpillar the other day. It was a really nice bond paying 4.5%, matures in 5 years or so. Well, if I try and buy that bond a week from now, there might not be any left because it might have been bought up by a lot of investors or institutions, and then they hold it on their books. Unlike the stock, whereas if someone says, Steve, I think Caterpillar stock is a great investment, you should buy it. Well, if I want to buy Caterpillar stock in a week, I can still buy Caterpillar stock in a week. It's always going to be there. So that's one of the differences in terms of the inventory availability of bonds. So what are the risks in bonds? Well, the main risks are credit risk and interest rate risk, right? And so what does that mean? Well, in general, interest rate risk is the risk that if you buy a bond today that yields 4%, and then in the next few weeks, interest rates go up dramatically from 4 to, let's say, 5%. Well, all of a sudden, your 4% bond doesn't look so good to other investors because they can buy a 5% bond. So that's interest rate risk, the risk that interest rates move against you in terms of what you own. Credit risk is the risk of when you do invest in a corporate bond, you're not just taking on interest rate risk, but you're also taking on credit risk in the sense that if that borrower doesn't survive over the life of the bond, well, then they go bankrupt. And then again, you have to go through that proceedings where maybe you get a claim to their assets and maybe you get some money back. But that's the credit. Credit risk is essentially the risk of a company going out of business or defaulting on their debt. So let's talk about more specifically about muni bonds and why sometimes they make a lot of sense for people in high tax brackets. So I have an example here of, because what you need to know about the muni bond yields is that there's always something that you should know, which is a tax equivalent yield, and that's based upon your personal tax rate. So if you're a wealthy individual who is in a high tax bracket, and let's use a 35% bracket as an example, and you have, and I tell you, hey, Mr. Wealthy Individual, or Mrs. Wealthy Individual, or Miss Wealthy Individual, you can get, I have a nice muni bond here that would give you about a 3.1% yield. Well, your question is, well, what does that mean in terms of what's the tax equivalent yield if I didn't have a tax benefit from this bond? And the answer is, it's math. Here's the equation. Essentially, you want to know that you would take the tax-free muni bond yield rate, which in this case is 3.1, divide that by 1 minus your tax bracket. So in this case, 1 minus 35% is 65%. So 3.1 divided by 0.65 ends up being 4.77. So what that means is, and if you would say, Steve, is there a corporate bond out there that has, basically the same credit risk and the same maturity that yields, over 4.7%, 4.77%. And if I said, actually, no, that I could only get a 4.5% corporate bond, then you'd probably say, well, then the muni sounds good to me. because I'm getting a better tax equivalent yield in the muni bond than I would from a corporate bond. So that's really why tax equivalent yields matter in the muni market. And that's why generally when you buy a muni bond, the yields are always going to be lower than the corporate market. It's just a question of, does it pay off for you as an individual to own that lower yielding muni because of the ultimate tax benefit of being federally tax-free? And if, let's say, for example, you're a New Jersey resident and you have a New Jersey muni, it's also New Jersey state tax-free. So that's called, in the muni bond, sometimes they're known as double exempt or double tax-free, meaning not only do you not pay federal taxes on the interest rate that the muni bond earns, but you don't pay state taxes. And believe it or not, sometimes New York City, there's something known as a triple tax-free bond. So if you actually are subject to local taxes in addition to state taxes, like many of our lovely New York City clients, resident clients, well, then there can be triple tax-free benefits, because a New York City muni bond, you will avoid federal, state, and local tax. And again, that can really pay off if you were in a higher tax bracket. So that's muni bonds, and that's why we do use muni bonds a lot for our clients who are in the higher tax brackets. Now, what about treasury bonds? Well, one thing I love about treasury bonds is that they're state tax-free. So they kind of have a little bit of what muni bonds have, in the sense that they do, you do not pay state income tax on the interest that you earn from a U.S. Treasury bond. And that is true no matter whether you're buying a bill, a note, or a bond. What's the difference? Well, Treasury bills are considered, Treasury bonds that have a maturity that's 1 year or less. Sometimes bonds or notes are referred to as ones that have maturities of more than a year, and they also pay interest. T-bills don't pay interest generally. Bonds do, and they usually pay interest every 6 months. And whether it's a bill or note, they always mature at par, which is known as face value, which is usually $100,000 per bond. So a couple other things to know about bonds. A lot of times if I buy a treasury bond for a client, sometimes they don't quite understand the math behind it and how it works. So one thing I always like to say, and T-bills are the easiest way to illustrate this, how do you understand the return? Like if I tell you, hey, I just bought a treasury bond for you with $955, it's going to mature at $1,000 when it matures. But what's the return? Well, it's basically the calculation is you take the change in price, and in this case, if it matures at 1,000, you know that the change in price is going to be a $45 increase. So you divide the change in price, which is 45, by the price that you bought it at, or what's known as the original price, which in this case was $955, and that equals your return or yield, which in this case is 4.71%. Feel free to check my math if you want. So that is really the way a T-bill works. So you buy a T-bill at a discount, it matures at par, where you get all your money back, and the difference in what you bought for it and what it matures at ends up being your yield. Now, not all bonds are that easy to calculate. What if your bond pays a coupon or an interest rate? And what if the bond matures in, let's say, 8 years? Well, then what you need to do is a little bit more of a complicated calculation, because you have to calculate, first of all, you have to add up all those coupon payments that you will earn. And what did we say? We said bonds pay coupons twice a year, right? So twice a year, you have to factor in the fact that you earned the coupon every year. And then you have to factor into the fact that you reinvested those coupons. And a lot of the calculations of bonds assume that you reinvest it at the current yield of the bond. Sometimes that's not an accurate assumption, but in general, this is what we use to do the T-bill, this calculation. But it's a lot more difficult when you want to do a bond that has a longer maturity, because then you've got to basically add up all the coupons, assume that you reinvest them at the current yield to maturity rate, and all the way until maturity. And then, and only then, can you figure out what the yield on that bond is. There's also, some bonds are callable, and a callable bond means that, hey, it might say that it has a 10-year maturity, but it might be callable in 5 years. So what does that mean? Well, what that means is the issuer of the bond, if interest rates are a lot lower, when in 5 years they might say, heck, I'm going to get rid of this this bond that I'm paying people a high coupon on, and I'm going to refinance it at a much lower rate. Not too dissimilar to what people do with their mortgages. If interest rates drop dramatically and they can get a much lower mortgage rate, they're going to tell the bank, hey, you know what? I don't want my mortgage anymore at the high rate. I want to refinance at the lower rate. Thank you very much. That's really what the call provision of bonds do. And to factor in that into the bond price requires option math, because essentially a call is an embedded option in a bond. So then you need to break out your Black-Scholes option pricing formula to factor into the bond yield. So I'm not going to do that right now, but that's part of the fun of calculating bond prices. Okay, corporate bonds. Well, the big difference from corporate and treasury bonds essentially have no credit risk. Why? Because they're backed by the full faith and power of the US government. And why is that valuable? It's because they have the power of taxation. So they'll never run out of money. They'll tax us to death before the US government runs out of money. So that's why they don't have credit risk. Corporate bonds, on the other hand, do not have that power of taxation. So they have credit risk. You need to know, will this company be around for as long as I'm holding their bond so that they can pay me back? And there are a few companies that have what I would call an oligopoly on the credit risk rating area, and those are Standard & Poor's, Moody's, and Fitch. They do credit ratings on all the corporate bonds so that I, as a corporate bond buyer, can look at what those rating agencies say about the credit worthiness of those borrowers to help me make an informed decision as to whether I want to take the risk of owning that bond. Corporate bonds also trade on spread. And what does that mean? Well, that essentially means that, let's say I buy a 10-year corporate bond, and someone tells me, yeah, that's trading at 35 over the treasury. That essentially means that if the treasury bond is trading at a 4% yield, that 45 basis point spread means that that corporate bond is trading at a 3.45% yield, and that's known as the spread. And we talked about the call provision. So I always think it's interesting. I did a search on our Bond Trader Flow platform to see what, if any, corporate bonds were rated AAA. Now, what is AAA? AAA is the highest possible rating you can get assigned by those rating agencies I was just talking about. And lo and behold, there are actually 2 corporations in existence today that have a AAA rating. That would be Microsoft, and that would be Johnson & Johnson. And so what does that mean? Well, what that means is essentially that the rating agencies, and this is, you can see this would say Moody's if you could see the whole screen, and S&P, they're basically saying that they think these 2 corporations' debt is as safe as owning a government bond. They really feel like there's virtually no credit risk at all for earning debt of Microsoft and Johnson & Johnson, because they think those companies have no chance of going out of business. So if you would think, therefore, that those corporations should trade right around where an equivalent maturity government bond was trading. And so let's see what the tape says. I just pulled up an equivalent search of US Treasury bonds at a very similar maturity, which is in basically, let's see, that's about a 4-year maturity or so, or 4.5. And sure enough, the yield to maturity of equivalent US Treasury bonds, about 3.55%. That's right where these bonds are. Well, since they're not government bonds, they're trading at a slight increase to the governments, but they're trading right around that same level. So basically, if you buy a Microsoft or a Johnson & Johnson bond, you're essentially getting very close to what you would get from an equivalent US Treasury bond. That's how safe they are considered. So when I talk about ratings, right, and here's Moody's, S&P, and Fitch, what do those ratings mean? How does that translate? Well, you'll see here is a breakdown of the rating scale that they use. And by the way, junk bonds, or what are known as non-investment grade bonds, are anything that fall below the BBB level. That's considered junk debt, meaning it's more speculative, meaning there's a much higher chance that the issuer of those bonds could go out of business. So this default rate, actually, I pulled out from an S&P Global study that was published a few years ago. And basically, what they're saying is, hey, you as an investor should understand that if we assign something a certain rating, what does that mean in terms of your chances of experiencing an adverse event? So in the case of a AAA rating, in the history of bonds, there has never been a default. And again, that makes sense. If it's AAA rated and you buy that bond, you should be 100% confident that that issuer is not going to default on your bond. AA is pretty solid too, less than 0.4% chance of default. Single A, similar, slight differentiation by 1/100 of 1%. Triple B is where we get into the zone of actually there's a 1% chance of default. So if I buy a triple B rated bond, which is right here, then of the 100 bonds I buy, one of them on average will go into default. That's still pretty darn safe, which is why people consider investment grade, even at the triple B level, to be very safe. It's only until we get to the double B ranking, which is well below investment grade, that the default rates go up. And in this case, 4.2% is the average default experience of triple B bonds. And then once you get into single B and below, well, now we're into double-digit default rates. You don't want to buy those bonds unless you really know what you're doing and are a good have a good understanding of the junk bond market. So basically, that's why when we do buy bonds, we tend to really stay in the A category. Sometimes we'll do triple Bs. As a matter of fact, why do we do sometimes triple Bs? Well, that's because you tend to get really good yields from triple Bs because you have a slightly higher default risk. So what do I mean by that? Well, here's a chart showing the yield to worst. What does yield to worst mean? It's basically the same thing as yield to maturity, but yield to worst is an acronym for yield to worst call, meaning if the bond is called, this is the calculation that's used. So what this is telling us is that if you invest in a AAA corporate bond, you're getting around, and I pulled this off recently, you're getting around a 4.25% yield to worst, basically yield to maturity. Double A close to 4.5, single A close to 5, and triple B, that's a pretty nice bump. Now you're getting close to 5.5%. That's why you would want to invest in sometimes bonds that are a little lower rated, because you do get that higher yield, and over time those higher yields can pay off. So that's really how we think about the bond market. That's kind of, one of the ways that we think it's really important for clients to diversify into bonds, and obviously not just corporates alone, but different types of corporates in terms of their maturity levels. So for example, this actually shows that the longer maturity you have on a bond, on average, by the way, the yield curve is inverted. So that's why right now a 1 to 3 year maturity is actually yielding higher than a 3 to 5 or a 5 to 7. But then as you get out to the higher maturities, you'll see in the corporate sector, the yields get higher. And usually in a normally sloping yield curve, the longer term the maturity is, the higher the yield you will get. And so we think it's very important to not just have diversity in terms of the type of bonds you own, a mix of perhaps governments and corporates, but then in the corporate sector, different maturities and different ratings. You want to be diversified. And then of course, if you're in a high tax bracket, it may make sense to not own corporate bonds at all and only be invested in municipal bonds because of that tax equivalent yield calculation, which may be more beneficial to you, as a result of the high tax bracket that you may be in. All right, so that is a quick refresher on the hot topic of bonds. Hopefully that was helpful. So really, a couple of things that I just wanted to point out in terms of what we were focused on year to date in the portfolios. Obviously it hasn't paid off to be conservative so far in 2023 based upon some of those numbers we were looking at for tech and growth stocks. But certainly that doesn't mean we think it's time to shift into those. As a matter of fact, I think caution is especially in order now because I think they probably got a little ahead of themselves. So when we're looking at stocks again, we want names that we don't think are overvalued and that we think are a little bit more defensive. And by defensive, usually that means that they have strong balance sheets. Usually that means that they've demonstrated the ability to maintain their margins in the face of higher inflation. And usually that means sometimes there are certain sectors that tend to be more defensive, like consumer staples. What's a consumer staple stock? Well, like a Costco, right? Because when you go to Costco, you're buying toilet paper, paper towels, toothpaste, things that you need to buy, whether or not the market is having a hard time. So that tends to be more defensive. Healthcare tends to be more defensive because, you know, if you're sick and there's a recession, you're still going to go to the doctor. So that's what we think is more important for portfolios right now. Now, it's not, you know, there are still a lot of positives out there. You know, corporation balance sheets are still pretty strong. Consumer balance sheets are still pretty strong, even though they are spending down their pandemic era savings. The labor market, we're still seeing record low unemployment numbers. And I think we have seen in peak inflation, inflation is coming down. It's going to be a question of how quick inflation comes down. And that's one of the things we need to really pay attention to. Oh, and another interesting statistics, and basically unlike, you know, 2008, only 5% of today's households have an adjustable rate mortgage. So that means that a large majority of mortgage homeowners, well, they've got a fixed rate mortgage that isn't affected by the dramatic rise in short-term rates that we've seen. And so that's one of the reasons why the you know, households haven't been that impacted by this rise in rates as they would have been back in, you know, the early 2000s, when over a quarter of all mortgage holders had adjustable rate mortgages. We talked about what's going on with the banking sector. Also, the debt ceiling politics, I'll just address that. I mean, look, at the end of the day, I think that's going to be resolved. I mean, there's no chance that the US will ever default on any of its debt. I do think that the longer this goes on, the more volatile the market will be. I've listened to a lot of commentary on this topic, and at the end of the day, there's probably going to be some type of compromise in legislation to either kick this can down the road or maybe rewrite things so that this doesn't become a continual issue that always comes up. But overall, you know, I really don't think it's a risk, and certainly the market does not appear to think it's a risk now either. It will get resolved. It's just a question of when. I'm sure the market will be volatile if it goes close to the wire. And that's one of the reasons that we want to be more defensive right now, you know, in names that are less volatile, because we do expect a little more volatility for the rest of the year. And I also want to point out that, you know, every time we do a stock highlight, the last time we did this, we talked about Microsoft and why we think Microsoft is a core holding in the portfolios. That has proven to be even more true this year. I mean, Microsoft is up over 30% year to date. A lot of that has to do with the hype around the you know, artificial intelligence, and Microsoft being one of the key players in that trend. But other big tech names like Google and Apple, which by the way are also core holdings in our portfolios, are also up over 30% year to date. So that's great news. More importantly, though, we always have been talking about how important it is to be internationally diversified. It's not just all about the US. So Mercado Libre, which some people know as the Amazon of Latin America, that actually has been a really nice holding as far as one of the core international holdings that we feel pretty strongly about. That's up over 56% this year. So I'm glad we've owned that. And then another stock that we highlighted a couple of times, a couple of quarters ago in this presentation, Comcast, better known as NBC Universal, is also up 16% year to date, which basically is double what the overall market is. So that's actually paid off too. That's you know, one of our favorite communication services sector holdings. So a couple of highlights there that we're pretty happy about. Obviously, we'll keep an eye on all the stocks in the portfolios. We're always, you know, reevaluating whether we really believe in the future earnings potential of these holdings and whether we need to make changes. And so, you know, we'll obviously be informing you of any changes that we make going forward. So hopefully this was helpful. It gives you some perspective of how we're looking at things. And as always, I like to remind our clients, in many cases, you know, many of you have been very successful in your careers and your lives, and, you know, you've entrusted us with your assets. And so we really want to be really good stewards of those assets. We want to make sure that we're prudent with those investments. We don't take unnecessary risk. We're not swinging for the fences unnecessarily for returns. We want to just be consistent, steady, and smart about the way we have your money make you money. So with that, I will close and move it on to any other Q&A we might have, Katie.
Great, thank you, Steve. come back on here. Like Steve said, if you guys have any questions, please submit them now. You answered a couple of them. The same one that comes up like last time too was inflation. I know you touched on that at the end. It is coming down. You expect it to keep coming down. Eventually too, I think people are worried that the high prices will just be the prices. So, but luckily I think you give us hope saying we can expect it to still kind of come down a little bit. The other one that we had here is the U.S. job markets have been a hot topic. Do you see, with a lot of talk of recession and layoffs, do you see or have you seen the pace of U.S. hiring slowing? And how does it, if at all, affect the market as far as stocks and kind of us and your position?
Great question. I love talking about the unemployment market because it is fascinating to me that it's still so low. The unemployment rate is still so low. So, first of all the leading economic indicators, in other words, there's a lot of leading economic indicators that people pay attention to try and predict when the recession, may in all earnest start. The unemployment rate is actually one of the last ones to show up in terms of a warning signal. A lot of the other leading indicators, everything from manufacturing numbers and other things, are flashing warning signals. Unemployment hasn't yet to, but that's actually to be expected because that's one of the last dominoes to fall. There have been numbers that show that we probably can expect an uptick in unemployment. Job openings have gone down. And obviously we've been reading about layoffs in many sectors. It's just a question of when that filters through to the numbers. So one thing I'll say about unemployment is that if we see the unemployment rate go up 0.4 to 0.5%, so let's just call it 0.5%. If it moves up 0.5% from its low level where it is now, which by the way, it's at a record low, it hasn't been this low since 1969, which is the year I was born. If it moves up by 0.5%, then it is followed by a recession 100% of the time. In other words, whenever the unemployment rate moves up 0.5% from its cyclical low, there is a recession 100% of the time. And quite frankly, that's what the bond market is telling us too. Because sometimes the stock market isn't really a good, doesn't really tell us if a recession is coming. The bond market tends to sniff these things out better than the stock market. And that's why the bond market is inverted right now, because the bond market does think there's going to be a recession. The problem is the bond market is not good at the timing of it. I mean, once the yield curve inverts, and by the way, the yield curve inverted in basically October of last year, it can be anywhere from 4 months to 2 years before we have the recession that the inversion is predicting. So, that's one thing that we really want to keep an eye on. I hope that addressed that unemployment.
Definitely. All right, if there are no more questions, then like I said, there were a few that you actually covered. So I think that it covers that. I just want to remind people before we end the webinar, there will be a survey that comes up in your browser when we end. And like Steve said, especially with our hot topics kind of featured in these upcoming presentations, it's helpful to know what interests you and what topics are important to you. So I don't see any more questions. So Steve, I will let you kind of wrap it up.
Well, thanks, Katie, and thanks for all of you listening. And I reiterate, we'd love to hear from you about what you like and what you don't like. We'll always try and do some more relevant hot topics next time. And if maybe I'll say that a sneak preview, we are thinking about real estate as a hot topic next time, in particular, the magic of a 1031 exchange and how that can be a very valuable thing for people who have a large gain in a commercial real estate holding. So that's a little preview of what the next hot topic may be, but we're always open to suggestions. And with that, I will sign off.
Great. Thank you. Thanks, Steve. Thanks, everyone. Have a good one. Bye-bye.